Hey, I'm Matt Caruso. In this video, we're going to look at trading habits causing you to lose money and stay unprofitable. These rules are really universal and apply to all investing styles, whether it's day trading, swing trading, or position trading. If you enjoy this video, please like, subscribe, leave some comments below. If I get some great traction, I'll be happy to make more of these. Now, these principles I know are universal because when I first started trading professionally, I was on the trading desk and we all had very different styles. It was always short-term in nature. It was a market-making department. We were the guys from the floor who had moved up to the screens. And we all had different styles, even though it was short-term. I mean, there are trends intraday. There's reversion to the mean. There's buying into weakness, buying into strength. Regardless, oftentimes, we would end up at the end of the day, compare notes, say, what did you trade? How much did you make? How was your day? And it would occur very often that we would trade the same stocks at different times of day and all make money off of that stock, but in very different ways. So the key principle, if you speak to enough professional investors, is not necessarily their style, but really that they have the key principles built into their approach that sets them up for success. Principle number one is asymmetry. Whenever you're looking to put on risk, that means if you're looking to lose 1%, you have to be looking to earn a multiple of that for your risk. Now, I know most people will think this applies only to more trend following type of strategies, but it really applies everywhere. Even when I was making markets and trading very, very short term, I had to always make sure that no single trade could kind of blow up and cause a series of profitable trades to be wiped out from one bad mistake. So sometimes, obviously, when you're day trading, that asymmetry will be less magnified, but it's something you always need to keep in mind. Now, specifically, if you're swing trading or position trading, you want to have that at least a multiple of upside for your given risk. Now, markets are difficult. It's very hard to have a strategy that's profitable more than 50% of the time. You can find some strategies that are very profitable, very high win rates, but they tend to not be very robust over long periods of time and survive changes in market dynamics. So that means most people investing, even professionals, are wrong most often, or the majority of the time. However, their losses are always very small and their gains tend to be bigger than their losses. So that asymmetry, looking for that before you put a trade on, say, what am I likely to make and what do I have to lose if I'm wrong, and make sure that your gains are going to outweigh your losses. Rule number two, and this really blends into rule number one, is you have to have the ability to identify when you are wrong in the trade or in the investment. There's no other way to really limit your risk and be an active investor. Now, the best example of how this can go wrong is the value trap. So for example, if you're someone who's looking for an undervalued company and you believe at $30 a share, given the PE ratio and dividend yield, etc., this is an undervalued company. Well, if it's undervalued at 30 and you buy it and it drops to 25, you're going to really like it at 25. If it drops to 20, you'll be even happier. And if it drops to 10, you're going to love it. The problem is you're significantly underwater. And what if you're wrong on this investment? I mean, it can very well be that all of the data up until this point in time has been great, but there's this big unknown, this unforeseen that you couldn't have planned for is already being priced into the market. And by the time you figure it out, it's too late. So you absolutely need a way to identify when you are wrong. Technically, you can use a chart. And if you buy a stock and you see it breaks below recent support, that can be one method. There are many methods. Even if you use value investing, you need to have a way where you identify that the conditions that you believed existed are no longer true. And you need to be able to benchmark how much risk capital you're going to allocate to a position that is wrong. There's no other way to set up that asymmetric return if you can't figure out where you'll be wrong if things go against you. Just like any business person opening up a business, you need to know when it's time to change your mind. Rule number three, your goals and your sell strategies have to match. If they don't match, you're never going to get to where you're going. Now, this may sound simple, or you may never even have thought of this, but oftentimes people will want to hold stocks, let's say, for example, for extended periods of time. They look at growth stocks, say, wow, if I could have bought this in January and held it for 9 months, I would have had a great return. But then they get into the position and 2 weeks later, they see a high oscillator, RSI oscillator, say, oh, we have to sell the stock. And they sell the stock. That's the start of a major trend. And you sold way too early when you were finally really right about your analysis, and you miss out on the gains you were expecting to make. Similarly, short term, someone could be a swing trader, very short term oriented. You put on your trade. As it starts to go your way, you call an audible. You say, well, I read that news that came out, and this stock can really have legs. And if only this occurs, next week at the investor conference, this stock's really going to, blow through the roof. And well, you've just changed your sell strategy, and your goal to take small swings within the market consistently over time has changed. And so it's very important that when you build your strategy, that your sell techniques are actually directly linked with your buy technique, so that your ultimate goal, the ultimate plan of what you're trying to do, is built into both the buy and sell side. That would be the equivalent of, not doing that would be the equivalent of opening up a toy store, and in January, when things are slow after Christmas, you decide to sell shoes. Well, it's not going to work too well for your customer focus and for your brand. So you really need to stay on point with what you're trying to accomplish. Rule number 4 is consistency, or the lack thereof. Inconsistency is what leads to so many people failing. Regardless, not everyone. I'm fortunate because I love what I do and I'm able to trade for a living. Most people don't have that luxury. However, there's no real benefit to 1 week spending 30 hours analyzing stocks and putting effort into the market, and then next week only putting 2 hours. Whatever you do, you have to build a strategy that works for your lifestyle, so the amount of time that you have to put in each week remains consistent. That way, if it's a strategy you need to select because of time constraints that doesn't allow you to trade every single day or to react to intraday movements, that's fine, but that has to be recognized before you try and implement that strategy so you can be consistent in its application. No strategy will work if it lacks consistency, because there are often times where you reach the exact perfect environment for your strategy, and if you are not absolutely executing, you're going to miss out on the bulk of your gains for that period of time. Other periods of time where your strategy isn't working, if you're not sticking to your risk management and watching your portfolio, you're going to be absolutely blown out. So that consistency is absolutely key. The last rule, the last principle, and for most people who've been trading long enough, I hope have gotten over this hump, but it's treating the markets like a business. It's not gambling, and there's no get rich quick end to this business. I know. I started trading. I was a teenager. Of course, once I saw the futures markets offered 20-to-1 leverage, naturally an 18-year-old is going to gravitate to there, and you look to make these big gains. And then there's this boom bust cycle you run into, and there's no shortcut to learning the right methodology, the right principles, the right way to invest in the market. Because even if you are right for a small period of time, the market has its cycles where certain styles work at certain periods of time and then they kind of stop working or they underperform. And it's only a consistent application over time that will lead to success. This is one of the reasons why so many people come to the market, lose a bunch of money, then walk away and never return, because their original intentions were not correct. There's a lot of misunderstanding about the market, especially for active investors. And there's this sense of get rich quick because there are a lot of scammers on the internet and in books that make it seem that way. But in reality, it's a tough, hard business. That's why some of the all-time greats like Stanley Druckenmiller, he's a legend, and he's returned 30% a year for 30 years. But 30% a year, that is not 500% in 2 months. There's no get rich quick. He's definitely very, very rich at this point, but it took a lot of time, work, diligent effort, and consistency. So I hope you enjoyed this video discussing the trading habits causing you to lose money and remain unprofitable. If you enjoyed this video, please like, subscribe, comment below if there's any other topics you'd love me to talk about. This is a new format I'm testing out. I wish I had a professional investor to speak to and chat with when I was learning how to invest. That wasn't the case, so I had to go to the School of Hard Knocks. But now through YouTube, I hope to kind of have a little more of a connection and describe my journey, my approach to the markets, and how I deal with this entire business. So talk to you soon.